Hey everybody, it is Thursday, means it's time for your Thursday Thought, and obviously the big thing that is in the real estate industry right now, can't see a news article without reading about it, is basically the federal funding rate, the 10-year treasury bond, and what those are doing to the 30-year mortgage average interest rate. It's been highly volatile. A few weeks ago it was in the mid sixes, now I feel like it's in the low sevens and maybe a little below. It's just kind of bouncing all over the place depending on the day or the hour that you call your lender. You may get a slightly different rate, but again, highly volatile over the past week. But I want to talk about kind of what that rate really translates to, and I wanted to kind of demonstrate how much it impacts affordability, but I also wanted to give a glimmer of hope because obviously homes are still selling. The last 3 months, our inventory has stabilized here in the Colorado Springs area, kind of plateaued, and homes are still selling every single month. Yes, we're down from last year, but cumulatively, from you look at January through September of 2021 through January through September of 2022, we're really not down that many units as far as sales go. So ultimately, I think we're maybe 9%, I think if memory serves right, although I have to double check that. But anyway, so I wanted to run through these numbers. So for this exercise, we're making some assumptions. We're making the assumption on a $500,000 purchase price with a 20% down payment, looking at a solid borrower with a good credit and their debt to income ratio or their low DTI for us to work with. So they're obviously financing $400,000. We're assuming $2,000 in property taxes and $2,000 in property insurance for this exercise. So I'm not going to step out of the screen here, but ultimately in December of 2021, the average was about 3%, like 2.98 or 3.01 was right around 3% in December of 2021. And if you'd have bought this house with these assumptions, your payment would have been $2,020 approximately, right? Real close. And then if you were to look over here today and you buy that same house, if you were to buy a home at the same price at 7%, your payment would be $2,995 or $975 difference, almost $1,000 difference by just waiting a few months. Again, assuming the same scenario and the same purchase price. So obviously, the homes are going to the market. Buyers just can't afford a $1,000 increase. And so that's why we're starting to see some prices come down. Since April of this year, they've come down about 7 or 8% on average. So about 1% a month. We've been seeing a decrease in the average pricing here in the Pikes Peak region. So two questions I wanted to kind of ask is how are homes still moving? And I mean, this is obviously basically a 50% jump in pricing as far as you're concerned, right? You went from paying $2,000 a month to paying $3,000 a month for the same house, but we haven't seen that, we haven't seen a 50% drop in housing price, right? So I want to talk about two things. I want to talk about, what would the home have to sell for today at a 7% interest rate to keep your payment about the same? And I have some jots out here for you to keep your payment around the $2,020 a month mark. That house would have to sell for on all other assumptions being the same, $328,000 or $172,000 price drop from the 500K mark. So that's I think everyone would agree, that's a pretty substantial drop. But for homes to be as affordable as they were in December, which is crazy to even say, right? People were complaining about affordability in December of 2021. So things are too expensive for me to go out there and buy. But when you look at what your payment would have been, it's actually not so bad. And that's why we've had such a frenzy in the housing market the past 2 years, is because actually homes have been affordable given people's monthly payment because interest rates were so low, and people have that ability to borrow that much. They do, and so that's why you saw, in part, why you saw so much of spike in house pricing. So again, to get this payment again in today, let's just say October of 22, you would have to buy that same house for $328,000 to keep this payment. So Yeah, this is all true. So then, how are people buying homes today? Well, there's really two things. One, prices are coming down, right? I mean, there's no way around it. Home prices are coming down about 1% a month, and so this $500,000 home that would have been there, in, let's say, the beginning of the year, is probably now a $450,000 home for all intents and purposes, based on the numbers that we saw come out in September. What's ultimately happening is that people are people are buying their rate down. The bank always wants to collect interest, but they don't care if they collect it on the upfront or if they collect it over the life of the loan, and they actually sometimes prefer to get it on the upfront. So what's been happening is buyers have been going to the sellers and saying, hey, Mr. Seller, I'll buy your home for, let's say, $500,000, but I want you to give me X amount of dollars in seller concessions. And that X amount of dollars is to the tune of $12,000, $15,000 in seller concessions. And then what they're basically turning around, again, seller concessions is where the seller at closing is giving a certain amount of dollars to the buyer to help with their closing costs. And closing costs can be basically buying the rate down or prepaying your interest. And so ultimately what they're doing, they're taking that $15,000 and they're buying this rate down from 7% to, let's say, a 6% mark. And again, these are all just rough numbers, right? And at a 6% mark, your payment would then be $2,732, which is still a $700 jump from here. Or if you get enough seller concessions, there's potential you can even buy it down, let's see, even lower than that. Let's just say 5%, which would put you at the $2,481 mark. So ultimately, I think homes are still selling because the buyers who are out there looking, they're finding creative ways to make things work. And sometimes that's a different loan product than your standard 30-year. That's a 2-1 buy down. Sometimes they have these special HELOC mortgages. Sometimes there are maybe they're doing a 7-year adjustable rate mortgage, which I think freaks a lot of people out, but they can be strategic moves for buyers who don't want to rent because they don't want to throw their money away or pay for someone else's houses, but they need to find a way to secure the house. This is some of the ways that they're doing it. They're buying the rate down or they're utilizing some other type of creative financing. But I hope this helps in just kind of visualizing on basically what the rate has done to our ability to purchase homes and how much it affects our payment. I mean, we're talking from a 3% back in less than a year ago, 10 months ago, to 7% today. It's about a 50% increase in this scenario, or about a $1,000 increase. And so between the home prices coming down and between the interest rates and being bought down, buyers who want to buy are still finding ways to do it that make sense for them financially. I'd love to talk to you about your scenario, whether you want to buy, whether you want to sell, and help you out on anything real estate. Give me a call. 216, look me up, message me. Thanks for tuning into this week's Thursday Thought, and we will see you next week on next week's Thursday Thought. See ya.